The gold to silver ratio. It's collapsing. Francis Hunt just dropped a bombshell that every precious metal holder needs to hear. He's not talking about $100 silver or even $200. He's talking about something far bigger, something the markets haven't seen in generations. While everyone's celebrating recent gains, thinking they've made it, Hunt warns, most people will sell too early. They'll miss the real move, the parabolic phase, the one that changes everything. It hasn't even started yet. And when it does, the last 5% of this cycle could deliver 50% of your total profits. But there's a catch. The very thing you're counting on, the dollar itself, might not mean what you think by then. What Hunt reveals next about 4-digit silver, it's going to shock you. Welcome to Currency Archive, where we preserve the financial wisdom that shapes your wealth. If you've been watching markets as long as we have, you know that moments like these don't come often. Do us a favor, my friend. Hit that subscribe button. Because what's coming in this analysis, you won't want to miss a single update. And tell us, where are you watching from today? Drop your location in the comments below. Now, let's dive into what Francis Hunt is really saying. Francis Hunt sat down for an interview that would shake the precious metals community to its core. His words weren't the usual market commentary. They carried the weight of decades of technical analysis and pattern recognition. He began with a statement that made investors pause. The gold to silver ratio is entering the contagion stage of its correction. For those unfamiliar, this ratio measures how many ounces of silver it takes to buy 1 ounce of gold. And according to Hunt, something massive is about to unfold. The technical charts told a story that most traders were missing. Hunt pointed to a critical level. The number 65. This wasn't just any number. It represented the neckline of a massive head and shoulders pattern, one that had been forming over years on the macro time frame. It's not the prettiest pattern, Hunt admitted, but it is a pattern. And that pattern had just broken. The ratio had climbed as high as 126, an extreme level that showed silver was drastically undervalued compared to gold. But now, the breakdown was happening in real time. Hunt's analysis suggested something remarkable. The ratio could collapse all the way down to the low 30s. But even that wasn't the end of the story. He believed it could overshoot, potentially dropping into single digits. To understand what this means, imagine a world where 1 ounce of gold only buys you 8 or 9 ounces of silver, instead of the current 80 plus ounces. The implications were staggering. Hunt then addressed the question that every silver holder was asking themselves. Is it too late to buy? His response was simple, yet powerful. If something is heading to $200, does $82 seem like too much? He let that sink in for a moment, then continued, You'll wish you had bought more. But Hunt wasn't talking about $200 as the endpoint, not even close. He was laying the groundwork for something far more explosive, something he called the law of the parabola. This is where things got truly interesting. Hunt explained that in exponential moves, most of the money is made in the final stages, the last 5 to 10% of the cycle. That's where half of the total profits materialize. Too many people sell too early, Hunt warned. He painted a picture that seemed almost unbelievable. The markets overreact in the opposite direction, he explained. Suddenly, everyone thinks silver is God money, and they react excessively. This wasn't hype. This was pattern recognition based on historical market behavior. Hunt acknowledged that he would sell at some point. There would be a cost to exit. But he admitted something unusual. He wasn't sure what the dollar would even mean at that point. Would it still be the dollar as we know it? A digital dollar? Something else entirely? The uncertainty around the currency itself added another layer of complexity. But in terms of old money, in terms of the dollars we understand today, Hunt believed silver would reach 4 digits. 4 digits. He wasn't making predictions lightly. His expectations were rooted in technical analysis, in understanding how markets behave during the final stages of major cycles. The contagion phase, he mentioned, this is when technical signals and momentum start reinforcing each other. It's when the move feeds on itself, when fear of missing out takes over, when rational valuations get thrown out the window. Hunt showed charts going back to the 1950s, demonstrating how volatility compression works. When markets squeeze for extended periods, they store energy. And when they finally release that energy, they don't just move, they explode. The break below 65 on the gold to silver ratio had triggered a macro reversal structure, one that pointed toward the low 30s with room for significant overshoot beyond that. This wasn't a gentle correction. This was the beginning of a violent reversion to historical norms, and potentially beyond those norms. Silver wasn't just going to outperform gold slowly. It was going to do it in a parabolic fashion, in a way that catches most investors off guard. The stage was set, the pattern was confirmed, and the move had already begun. The conversation took an unexpected turn when Hunt revealed something most analysts were completely overlooking: the supply-side equation. While everyone focused on price targets and technical patterns, Hunt understood that silver's real story was buried deep underground, or rather, not being dug up at all. He dropped a statistic that changed everything. 60 to 70% of silver comes from mining other metals. Let that sink in for a moment. The majority of the world's silver isn't even being mined for silver. It's a byproduct, an afterthought, a happy accident that happens when companies dig for copper, zinc, lead, or gold. This meant something critical. When silver prices rise, production doesn't automatically increase. The miners aren't chasing silver. They're chasing iron ore. They're after copper deposits. They're hunting for gold veins. Silver just happens to come along for the ride. Only 30 to 40% of global silver supply comes from actual silver miners, people whose primary mission is extracting silver from the earth. A really bad situation, Hunt stated bluntly. The implications were profound, and most investors had no idea. Traditional economics teaches that when prices rise, supply increases to meet demand. Miners see higher prices. They dig more, and eventually the market balances. But silver doesn't work that way. The companies pulling silver out of the ground as a byproduct, they don't care much about silver prices. They've already committed their energy and resources to extracting the primary metal they're after. They're going down to get the iron ore, zinc, gold, copper, or something else, Hunt explained. We've already used up our energy, but the silver is still there, so we'll take it out. But here's the problem. These companies can't predict how much silver they'll find. It's not their focus. It's not why they're drilling. It's just whatever happens to be there. It's an accident. A nice side effect, Hunt said. We'll see it if we see it. We don't if we don't. This created a supply crisis that price alone couldn't fix. Even if silver hits $200 or $500 or higher, the byproduct miners won't suddenly start digging more. They're not silver miners. They're following completely different metals, completely different economics. And the dedicated silver mines, many of them had been shut down, mothballed, deemed uneconomical at suppressed prices. Hunt explained that there were known silver deposits, rich veins, quality ore bodies, sitting untouched. The problem? At artificially low prices, it cost too much energy to extract them. Making a hole in the ground to get silver takes too much energy for the price being offered, he said. Only price could fix this. But even then, it takes years to open new mines, to build infrastructure, to bring production online. The market was setting up for a supply squeeze unlike anything seen in modern times. But Hunt wasn't finished revealing the hidden forces at play. He shifted to demand, and this is where things got truly explosive. The world was being pushed into electrification, whether people wanted it or not. Electric vehicles, smart grids, renewable energy, the so-called green transition. And every single one of these technologies had something in common. They devoured silver. Hunt mentioned the new solid-state batteries, the ones that could power electric cars for 900 kilometers on a single charge, the ones that could recharge to 80% in just 8 minutes. A revolutionary technology, but here's what nobody was talking about. That would need 20% of those highly superior batteries, which means it would need 100% of the silver currently being produced. 100%. If just a fraction of the planned electric vehicle rollout happened, if even 20% of new cars use these advanced batteries, the entire global silver supply would be consumed. Nothing left for solar panels. Nothing for electronics. Nothing for industrial applications. Nothing for anything else. No silver for gadgets. No silver for anything else. No silver for solar panels, Hunt emphasized. And the solar panels themselves? They require silver too. The weapon systems? More silver. The smart grid infrastructure? Even more silver. Everything, absolutely everything in the planned technological future needed massive amounts of silver. The supply couldn't respond quickly, and the demand was about to explode. Hunt had just revealed the perfect storm, and most investors were completely blind to it. Hunt leaned forward, his eyes focused, and began revealing the tactical side that separated professional traders from hopeful amateurs. There are real ways to maximize this move, he said. This wasn't theory anymore. This was about actual entry points, actual risk management, actual money on the line. He pulled up his screen, showing his own trading platform, the one he actually used to place real trades, not hypothetical charts, not educational examples, but positions he had skin in. The screen told a story of patience, precision, and perfect timing. Hunt addressed the elephant in the room, the question that haunted every investor watching silver climb higher and higher. Where do you enter when the monthly chart looks like this? He was right. The monthly time frame showed silver in a relentless uptrend. No pullbacks, no obvious entry points, just straight up. People were saying there were no cheap entries left, that the train had already left the station, that buying now was chasing. As long as you stay on one time frame. They're right, Hunt acknowledged. But then he revealed the secret, multiple time frames. While the macro picture showed an unbroken rally, the shorter time frames told a completely different story. They showed volatility, they showed pullbacks, they showed opportunity. Hunt zoomed into the daily chart. Suddenly, what looked like a relentless rally on the monthly became a series of waves, corrections, consolidations, and entry points. Having multiple time frames is helpful because it means you can keep getting entry chances, he explained. He pointed to a specific moment when everyone was declaring that gold, silver, and Bitcoin had topped out. The mainstream narrative was screaming that the precious metals run was over. What did we get? Hunt asked, then answered his own question. We were given a chance to re-enter during this daily time frame. He had taken it, placing not one, but 2 entries during that pullback. His stops were clearly defined, placed at logical technical levels, not arbitrary numbers pulled from thin air. He used what he called relative lows, points where the structure would be invalidated if breached. The method? HVF, high volume flush. This was about waiting for moments when weak hands panic, when leverage gets flushed out, when the market shakes out the tourists before resuming its march higher, and it had worked. Beautifully. Those stop losses he had placed during the pullback, they were now trailing stops, locked in guaranteed profits. The positions that seemed risky when everyone was screaming top were now deep in the money. About 150% on these, about 305% there, and we're going higher, Hunt revealed casually. This wasn't luck, this was systematic. He then pulled up a chart that made everything click into place. The quarterly silver chart going all the way back to the 1950s. Decades of data condensed into one powerful image. Hunt pointed to periods of compression, times when silver went sideways for years, volatility dying, traders getting bored, capital flowing elsewhere. Squeezes limit instability, but they store energy for big moves in the future, he explained. The current setup showed a squeeze inside a squeeze, a compression within a compression, like a coiled spring being wound tighter and tighter. The breakout level was clear. The stop loss was tight. And the target? $333. But Hunt was quick to clarify something crucial. That won't be the high. It will be a resting place for a while. This was the midpoint, not the destination. A place to take partial profits, to lock in gains, to reduce risk, but not to exit completely. We only do a partial close of about 50% most of the time, Hunt said. This was professional risk management, not the all-or-nothing gambling that destroyed most retail traders. Hunt then showed something that would change how people viewed this entire move. He pulled up the gold to silver ratio chart, but not the recent data. He went back, way back, all the way to the 1960s, to the Vietnam War era, to the Gulf of Tonkin incident in 1964. What he revealed was shocking. The current ratio readings, the ones that seemed extreme, they were actually artifacts of financialization. They didn't represent natural market dynamics. They represented decades of manipulation, suppression, and distortion. Everything has become more like money, and silver prices have been pushed down compared to gold prices, Hunt explained. He cited historical ratios. In ancient Egypt, it was 8 to 1. Other periods showed 10 to 1, 12 to 1, 15 to 1. But during the era of financialization, the ratio had been deliberately driven higher to 30 to 1, 50 to 1, even 100 to 1 at extremes. This was the suppression of the Silver Age, when massive above-ground inventories were dumped to keep prices low, when paper silver derivatives multiplied like rabbits, when the physical market was buried under financial engineering. If you have too much inventory, you can always let values stress, Hunt noted. But here's what changed everything. Everything says that if you do not keep it in a safe inside the borders of your own country, you don't have it. The inventory was gone. The above-ground stockpiles that once suppressed prices had been consumed, melted down, turned into solar panels and electronics and industrial applications. The world was waking up to physical ownership. And when the ratio reverted, when it returned to historical norms, when single digits came back into view, the moves wouldn't be measured. They would be violent. Hunt had positioned himself perfectly, and he was showing others exactly how to do the same. Hunt's final revelations carried a weight that made everything else seem like preparation. He addressed the question that would define fortunes or destroy them. When should I sell my silver? The room seemed to hold its breath, because this was the moment that separated generational wealth from regret. Hunt's answer wasn't what people expected. The exit for silver will depend on the gold to silver ratio, not a price target. not a date, not a feeling, but a relationship between two metals that had danced together for thousands of years. He explained that silver's value was never about its standalone price. It was always measured against gold, and that ratio, that ancient relationship, had been distorted for far too long. The ratio had been elevated, stretched, manipulated through an era where everything became financialized. Paper promises replaced physical metal, derivatives stacked upon derivatives, and the true supply-demand dynamics were buried under layers of financial engineering. But the correction was underway. Hunt pulled back the curtain on what most people didn't understand. The ratio compression on the quarterly chart wasn't just technical, it was existential. This pattern, this squeeze going back 70 years, it stored energy like a dam holding back an ocean, and when it breaks, it doesn't trickle, it floods. Long-lasting squeezes store energy, so when they stop, prices don't go up. They explode, Hunt stated with conviction. The structural break was already confirmed. The move toward the low 30s on the ratio had begun, but even that wasn't the end point. Historical patterns showed overshoot, they showed emotional extremes, they showed markets that didn't stop at fair value. They blew past it. And this time, the fundamental backdrop made overshoot almost inevitable. Hunt circled back to the supply crisis. But now, with the full picture painted, only 30 to 40% of silver production came from dedicated silver miners. The rest was accidental byproduct. This meant supply was fundamentally inelastic. It couldn't respond to price signals the way normal commodities do. Meanwhile, demand was about to go parabolic. The solid-state battery revolution alone, if just a fraction of planned electric vehicles adopted this technology, would consume 100% of current global silver production. 100% for batteries alone. Nothing left for the solar panels that governments were mandating. Nothing for the smart grids they were building. Nothing for the defense systems that required silver's unique properties. Nothing for electronics. Nothing for industrial applications. Everything needs more silver now, Hunt emphasized, and the market was only beginning to wake up to this reality. He returned to the law of the parabola, because this was where most investors would fail themselves. The exponential phase, the final stage, the part that looks insane from the outside, that's where the real money gets made. Most of your money is made in the last 5 to 10%, Hunt repeated, making sure it sank in. The last 5% of the time cycle delivers 50% of the total profit. But here's the tragedy. Most people won't be there to collect it. They'll sell at $100, feeling smart, then watch it run to $200. They'll sell at $200, thinking they've won, then watch it explode to $500. They'll convince themselves that $333 is the top, the rational target, the place to exit, and they'll miss the overshoot to $1 in $500 or $2,000 or whatever four-digit number the market decides is extreme enough. Markets overreact in the opposite direction, Hunt reminded everyone. When the crowd finally believes, when silver becomes God money in the public consciousness, when the fear of missing out overwhelms rational analysis, that's when prices detach from fundamentals completely. And that's exactly when Hunt planned to sell. But even he admitted uncertainty about what that moment would look like. I don't know what the dollar means at that point. I'm not sure what kind of money will be used, if it's still a dollar, a digital dollar, or something else. The currency itself might be in question. The measuring stick might be broken. The entire monetary system might be in transition. But measured in today's dollars, in the currency we understand now, Hunt's conviction was clear. 4 digits. He wasn't alone in this view, but he was among the few willing to say it publicly, to stake his reputation on pattern recognition that most people dismissed as impossible. The charts didn't lie. The supply dynamics didn't lie. The demand trajectory didn't lie. Hunt showed one final insight. The gift within the gift. Markets want to love you and give you gifts, he said, painting an almost poetic picture. We're like blind animals walking on pearls, gold, and diamonds. All you have to do is bend over, open your eyes, and pick them up. The pullbacks, the volatility, the moments when everyone screams that it's over, those aren't threats. They're opportunities. They're the market giving patient traders another chance, another entry, another gift. But only for those who understand multiple time frames, who manage risk properly, who don't panic when the crowd panics. Hunt's message was complete, layered, technical yet accessible. Silver wasn't just going higher, it was entering a phase that most living traders had never witnessed. A phase where decades of suppression reverse violently, where supply constraints meet explosive demand, where the gold to silver ratio returns to levels that seem impossible until they happen. The contagion phase had begun. The pattern was confirmed. The fundamentals were aligned, and the only question that mattered was whether investors would have the courage to hold, the discipline to manage risk, and the vision to recognize the gifts the market was offering. Because this move, This generational shift in precious metals, it wasn't going to wait for anyone. The train was leaving the station, and the final destination was far beyond what most people dared to imagine. Hunt had laid out the roadmap, shared his positions, revealed his targets. Now it was up to each investor to decide, would they be among the few who captured the full move? Or would they become another cautionary tale, another person who sold too early, another story of what could have been? The charts were clear, the fundamentals were undeniable, and time was running out.